how do mortgages work? So in this episode, I'm going to be explaining and walking through how mortgages work. It's an interesting question. We're going to cover things like what a mortgage is, the types of different mortgages out there, the mortgage process, costs involved. I'll give you like a scenario of how much you'll pay and things, repayment options, mortgage term, legal process, financial protection, and then give you like an overview of my thoughts as we close. So this is an interesting topic because if you're in the scenario of wanting to buy a house and you're in this process, then you'll find this helpful. Again, this full presentation will be available on zulftalks.com. You basically click the button and you'll get show resources, so I can walk you through that so you don't have to write notes basically. So what is a mortgage? Let's consider this in the terms of someone new, or if you're in the place where you're thinking about buying it. So these are it's basically borrowing. So we already did an episode last time where we talked about different types of borrowing, like credit cards, loans, borrowing from an overdraft, and different ways of getting money. If you're making a purchase for a house, then you would get a mortgage. That's like one of the main ways to get a mortgage. So what is a mortgage? It's basically borrowing money, a type of loan, to buy or refinance house, property. Like, you know, it can be a commercial or whatever it is, depending on the type of mortgage, which we'll talk about in this episode. The loans are normally for a long period of time, so don't be scared if you see it's like for 25 years or 30 years is how long it'll take you to pay back. Because remember, you're buying a large purchase. Cost of a house probably typically like 250,000 pounds for like a reasonable house these days, and they're normally provided by banks. So you're basically saying to your bank, can I borrow some money? I want to buy a house. And the bank is like, okay, yeah, we'll give you the money, but we're going to make sure the house is worth how much you said it's worth, and also that we can get our money back if you can't pay us. That's basically what a mortgage is. So that's like a layman's explanation. I like to keep these simple, so if you're totally new, hopefully this makes sense. Now, we touched a little bit here in the start about types of mortgages. So why are types of mortgages quite important? The reason is because you can borrow money and you can pay back a little bit every month towards what you borrowed. Or you can look for different types of mortgages where you only pay the bank back interest. It's like a buy now, like a buy to let is like the official thing. So if you're buying the house for yourself, you're living there yourself, it would be probably advisable to pay back some of what you borrowed and some of what it costs to borrow the money. So let me go back a little bit. If you're borrowing £200,000 from a bank for a house, you're not going to pay the bank back £200,000 because they're having an element of risk to borrow you some money. So what that will mean is we need to consider how much are they going to charge you. So that goes into like interest rates and stuff. So types of mortgages is basically an option to think about. But let's just quickly talk about what it involves. So what's the actual mortgage process? Because that leads us nicely to this. So we've already covered that. We're looking at £200,000. We want to buy a house. We go to the bank. Well, before that, you'll probably have a look at a few houses, be on like the app, have a look at houses, Zoopla, those kind of things. You're finding out what the price is in your area, how much does a house cost of the type that you want to buy, and you work out, do you have enough money for that? You can use mortgage calculators online to help you. So say, for example, I want to borrow £200,000 for a house. I'll be like, okay, I want to borrow that, but how much will I need to pay back? Like, you know, that's a big number. If it's over 25 years, what am I paying back? Like £3,000 a month, pounds a month or something. So you can use a mortgage calculator. Normally bank providers offer this. In the resources, I'll leave you a link to NatWest mortgage calculator. It kind of helps you put in how much you want to borrow. You can't borrow the full amount, which is another thing. So part of the process is you want to borrow £200,000. The bank's going to say to you, actually, you know what? You need to pay some of that yourself, which is where you pay a deposit. So you pay maybe £20,000, £20,000, £30,000, and the remainder you get from the bank, which then makes up the full amount you want to borrow the house for. The reason that they do that is like a bit of, it's basically you putting your own money in there, saying, you know what, I am going to pay this back, and it gives them a bit of security. I think that's the main thing. And so that's why in earlier episodes, remember I used to speak about savings accounts. So if you're planning to buy a house, putting a little bit of savings away, so you're getting like a building up a little bit of money towards your deposit. So whether you buy a car, whether you're buying a house, it's a good idea to have some type of money available. The more money you have, the better for you, because you're paying less interest back. Because think about it, if you were to borrow £180,000, you're going to have to pay interest for £180,000. But if you were able to save £50,000, you'd only have to pay on the £130,000 because you've already got 50, so you don't need as much to pay for the house. So in that example, that's the process you normally apply to the bank. The bank will go through an application process and give you an agreement in principle. There's a lot more involved in this. So what they'll say to you is like, okay, what job do you do? How long have you been working? How much salary do you get paid? How old are you? If you're going for a 30-year mortgage, are you still going to be working in 30 years time? Or are you close to retirement? Will you no longer be having an income of the same amount? These types of things. How secure is your job? They'll do like a credit reference search. In previous episodes in this season, remember we did one about what is a credit search, how to check your credit history. So I'll link all of that in the show notes, and you can check like the previous season. So we're on season 14 now. So this is all about finances and money. So you'll know how we're progressing. If you've been following me so long, it's great. Thank you for joining me. If not, check back on some of these episodes. Again, this is the podcast version of this episode. It is available on Spotify with video and YouTube, so you can see the slideshow that accompanies this if you're watching on another version, if you prefer to see rather than just hear. So the mortgage process, we're at the point now where we've done the application. The mortgage company, the bank says, normally it's always banks or finance companies, it'll say, yes, okay, we're willing to borrow you this money. Go and have a look at a house. You go and look at a house, you have a mortgage in principle, which means based on what you told us so far, we think we can borrow you the money. But then a full application will go ahead when you actually buy the house. So they do like a proper check and everything to make sure, yeah, okay, this guy's okay. And that can take like sometimes 8 weeks, 2 months, 3 months easily. If it's a good company, quicker. But in my experience, I bought 2 houses, 3, 2, 4, somewhere along there. And the first 2 mortgages took long to go through. That was previously like going back, 10 years now or something. So now I'm assuming things are getting more, more, not harder, more intense. Like, they need to make sure all the checks are done, especially since in the past, banks have not really done the right amount of checks and people have gone into like debt and the bank crash and all this. We'll talk about that in another episode. So the process there, I've briefly skimmed over the process. And then you've bought your house, you get a mortgage, they send a surveyor out, they make sure it's worth the amount you said. The bank will send that money to the solicitor. The solicitor will send that money to the person you're buying it from. He'll pay them, and then you owe the bank that money basically, and you're 25-30 years you need to pay that back. If you don't pay it back, you're risking your house being taken, as well as you're losing the money you put in there, the deposit, because remember, you're putting some money in to make it a bit lower. So the lower amount you can borrow, the more affordability checks you do, it's good for you, because then you know what you're doing. This goes back to our previous episode where we talked about savings and plans and making sure you know where you're going with your financial goals and buying. So what are the costs involved? It gets quite expensive, to be honest with you. Now, these costs are broken down. So first, when you get a mortgage application, most of the time, you won't have to pay for like an application if you're doing it yourself through NatWest or a bank, but you might not get a good interest rate. So a lot of the banks will give you like, okay, if you borrow £200,000, you'll have to pay us back 6% or 7%, or it's gone up to 11 or 12% recently, I think. So that's where basically you're paying back more for borrowing that money. If you go through a financial advisor or a mortgage expert, they have access to more deals which are available only to them. So they might be able to say to you, you know what, if you go with us, we'll be able to give you one at like 3% for 2 years, and then after that it'll be 1.2 above the normal base rate of whatever it is at the time. So base rate refers to what the general rate is for everybody across the board. So there's costs involved there. If you have a financial advisor, it might cost you £500-600 to pay them to sort your mortgage out, but that might be worth it. If you're saving a lot of 2%, 3% on a big amount, is going to be over a long period of time, it's going to be a lot of money. So it may be worth you paying an advisor. Or if you go through the bank, NatWest or Barclays or Halifax or any of the big banks, they might charge you like a fee for the application. So there's costs involved there. During the process of getting the house, you will have to have fees for surveying the house. So you've got mortgage application fees, you've got surveying the house. That basically says, is the house worth what it's saying. You can have a basic search, you can have a detailed search. So all of these little things are costs involved in getting the application. There will be the cost in terms of the rate, the interest rate you're paying back, because that's the type of cost. So it can get quite expensive, especially if you're applying as a first time mortgage. So normally have about 10% on top and you'll be okay, because there can be hidden costs. Like the mortgage application might have £1,000 fee for the application. Your solicitor is going to charge you some money to do all the paperwork, so that's another couple of £1,000. So you're looking at £3,000 before you get started, really. So about £5,000 minimum for a standard application. There's also things like tax and not tax, stamp duty. So if you buy a house for a really high amount, and in your area, any house under £150,000, for example, doesn't need to be taxed, stamp duty. So if your house is above that, you have to pay like 5 or 6% stamp duty. So that's another fee or cost involved. So all of these, it's advisable to check online to specifically see how much you're borrowing, check the rules. So research is very important. And if in doubt, your solicitor will normally tell you all of this stuff anyway. But at least now you're preparing yourself, you'll know what types of things to expect, so not something doesn't come as a surprise. So you've got a few things there that will be involving costs. And then also, once you've got the house, removal, like, getting a company to bring your stuff in. If you've got a lot of stuff you're moving and you're not doing it yourself, there's costs involved there. So like maybe hiring a van or a whole van thing in America they call them. Repayment options, we touched on this a little bit earlier. Repayment is basically, how are you going to pay the money back? Are you paying us back capital and interest, so what you borrowed and interest, so slowly over time your mortgage goes lower and lower? Are you paying us back only the interest because you're saving money in like a pension or something else that you want to pay as a bulk sum or a separate stocks and shares or something? So that tends to be the main couple that you would pay back. Over time, you will ideally want a mortgage that lets you put extra money into it. The reason we want to do that is, the main goal is, if your interest rate on your mortgage is high, and say for example your interest rate on your mortgage is 10% or 9%, for example, that's very high, but say for example it is, and you've got money saved, because if your early episodes we talked about savings, and your savings is only paying you 5% interest, it'll make more sense for you to use that money in your savings to pay off some of your mortgage. So you're saving. If that makes any sense at all. If you're listening, hopefully that makes sense. It's basically, rather than have a savings account paying you 5% and it's costing you 10% for your mortgage or 9%, you're paying more in interest for your mortgage. So rather use that money to pay off some of your mortgage. Where they get special accounts come into play here. You can have accounts where you can save towards your first house, the first time buyer mortgage, where you put money in your savings and it offsets it and things. It gets a bit complicated, but more research for those. There's loads of good examples online in the show resources. I'll put a few websites you can check out. Repayment options. So you're paying back your mortgage, you're thinking about the types of rates you're paying back. Can you pay it back in a better way? If you're saving money, can you use some of that money instead of in savings? Because we talked about savings options, paying off some of your mortgage, so you're not as in debt for long. Because if you're paying off quicker, you won't have to pay, so you'll be independent and mortgage free sooner. I think I was able to get mortgage free in 7 years, so that's like going back, where I basically put all the money I earned into the mortgage to pay it off, because I didn't want to pay interest, and rather than have money sitting around in savings accounts, I'd rather clear off the mortgage so I don't have a mortgage to worry about. And it takes time, so you have to be very strict. You have to save the money, you have to not spend on useless things, so you have to be a bit tight until you get mortgage free, and then you're okay. You can't live a luxury lifestyle and also think, oh, you know what, I'm living on borrowed money. If you have borrowed someone's money, you need to pay the money back. So that's very important. It's also, you borrowed it from a bank, even if it's a family member or someone, you need to pay them back. Okay, so mortgage term. So how long is a mortgage term? So normally you can choose a longer period of time if you want to. It helps bring down the monthly cost, for example the mortgage repayment cost. So if you're going to have a mortgage term of 25-30 years, if you're young enough you can do 35-40 years, but just consider what the monthly amount is that it's going to cost you to pay back. So if you're paying $500 or £600 a month towards your mortgage, if you increase the time period you're paying it over, you're going to pay interest for a longer period of time. However, your monthly repayment will come down a little bit. So mortgage term is something you can use to flex about to make sure the amount you're paying back leads to you. In terms of the legal process, it's important to make sure the house you're buying is, well, freehold. Freehold basically means the person owns it outright. So like some houses you'll have where the house is free, but the land is like owned by someone else. So they pay like a special stamp duty rate or like a rental for the land, but not the house. There's loads of complexities out there. So at this point, you want to get a solicitor. At any point you want to get a solicitor, you have to have a solicitor, because they're going to do out all these processes. Like for example, they'll do searches for the house to check the drains, the water, all like the legal elements of the house, property boundaries, getting like a land registry to make sure that the boundaries on the house are correct, that there's no disputes with neighbors. All these little things make up the legal process. So it's worth paying for a good solicitor who does all of this for you, because then it's peace of mind when you buy the house. Because if it's not done well, you're going to lose out quite a lot of money, because you've got your application fee, your solicitor fee, your surveyor fee. There's types of insurances out there that can cover you, so we'll talk about those. But the legal process is the solicitor will go through this and check all this for you. Then you get to a point where once you've paid, you've got your mortgage, you can do an exchange. So the deeds will become on your name. Deeds refer to the house's paperwork, like a document to say this is your house. Or there will be, the deeds will be a document that has, if you're buying it with the mortgage company, the mortgage will have a hold on the deeds as well. Because then if you're not paying it, they can take the house if you don't pay your payments back. That's where repossessions come into play, like if you default on your payments. So financial protection, what financial protections are out there for you for mortgages? So at the same time, with the protection element of things, you've got financial protection at different levels. So you can look at things like mortgage protection insurance. Once you take out your mortgage, and if you're sick or you don't get any money coming in salary wise, there's types of cover available that will pay your mortgage off, like for that period of time, depending on the illness and things. You need to get proper advice about this, speaking to solicitors and proper mortgage experts to find out the types that are out there. When you're taking advice from a financial advisor, there's things like the FSCS. So it's basically a regulated service that gives advice about mortgages, because not everybody can give you advice about mortgages. Again, this is an information video, so I'm just sharing data that's available for you to understand the steps and the processes. But for your personal circumstances, you will need to get a qualified mortgage advisor who can walk you through the process and help you with the financial protection insurance, making sure you've got everything in place. So is it worth it? Closing thoughts in terms of mortgages. In this day and age, it's becoming more and more difficult to get a mortgage. So if you're struggling and you're thinking about buying a house, you know what? It's very difficult at the moment for a lot of people. Income, expenses, interest rates, everything's really high. So getting a good mortgage is going to be difficult. Getting through an application is going to be very difficult, because they need a lot of paperwork, and a lot of people need to be working in a stable job, have wage slips and all these documents to go through it. It can be done still, but you need to be very, on top of it. You need to be on your case. You need to plan for this, understand how much it's going to cost you, what job you're doing, how much you're going to be paying, how much you want to borrow, what house you're buying. Does it make sense to rent, or does it make sense to buy? These are all questions that you need to ask yourself. So I think from this point of view, there's loads of different areas you can consider. But I would say, if you can, having a house of your own, especially if you want to, raise a family, is an option. But a lot of people buy and rent and move around a lot. So it depends what type of person you are. And it's all individual. So make sure you understand what you want to do, what your goals are. And I would personally, all day long, buy a house, get a mortgage. And then if you want to buy and save money and you've got a good plan in mind, you can maybe rent out, rooms, or discuss those things once you pay your mortgage off, or discuss that with your mortgage provider, because there's rules about renting your house out if you have a mortgage, because there's different mortgages that apply. Now that's like an overall information download for you to understand. Everything I talked about today is in my show notes, zulftalks.com, so you can check this presentation out that I went through today. In summary, what did we cover? So we talked about what are mortgages, types of mortgages available out there, like buying to let or house, like for your personal use, the costs involved in a mortgage, that's quite important, as well as the mortgage term, repayment options, legal process, insurances, and I give you like a bit of an overall closing thoughts to see what is going on. I'm hoping you found this episode useful. I will link you to the next episode in this series, because remember, we're on season 14 of this episode. We're talking about finances and money. So I'm taking a specific topic each time and talking about it just to help those that aren't sure, or they want to do something and they're thinking about it. You'll be able to find the next episode in this series here. Check that out, and I'll see you on that video, give you a bit more information. It would be really good if you can leave a review wherever you're listening to this. The show resources are available at zulftalks.com. You can also sign up to the mailing list there, which will allow you to get information to help you on your journey working for yourself.